Before we begin, please be advised that trading foreign exchange and financial products involves a high level of risk. This content is strictly for educational purposes and does not constitute financial advice. You are solely responsible for your own investment decisions. Welcome. Today is Tuesday, January 27th, and we are breaking down the current narrative for the euro to US dollar pair. To achieve consistency, it's vital to master market reading from higher timeframes. This provides the necessary bias to trade effectively on lower timeframes. Looking at the weekly chart using New York time, we identify critical liquidity pools dating back to 2021. These equal highs and by side liquidity (BSL) levels represent massive order volumes waiting to be triggered. Currently, the visible scenario suggests a strong bullish momentum. However, we must look beyond the obvious. While the market appears to be in a buying phase, institutional investors often drive price toward these liquidity zones to execute their counter positions. We should anticipate that as price approaches or sweeps these highs, a retracement toward the established demand zones or negotiation areas is likely, seeking equilibrium before the next leg up. Continuing with our macro outlook, it's essential to track risk correlations across the board. As euro to US dollar maintains its bullish structure, we notice a parallel move in the S&P 500 E-mini futures. This synchronicity signals a clear market sentiment, where risk-on appetite is driving both assets higher simultaneously. Taking a closer look at the S&P 500 weekly chart, the structure is telling. We are currently navigating a textbook Elliott Wave formation. After completing a corrective cycle at the Wave 4 level, price has launched into an aggressive expansion toward the Wave 5 target. This sustained uptrend reinforces our euro thesis, yet it demands meticulous execution. When the market moves in such an obvious direction, precision in entry zones is paramount to avoid being caught in natural price retracements. Zooming into the S&P 500 chart, the structure reveals crucial clues about institutional positioning. There is a direct inverse correlation we must monitor. If euro to US dollar continues its climb, it implies intrinsic weakness in the dollar, which typically fuels equities. However, this is where we must exercise caution. While price has the momentum to reach a new all-time high, ADH, the market has left footprints along the way. We can identify several fair value gaps, FVG, on the weekly timeframe. These are zones of inefficiency where significant order volumes remain unfilled. The narrative suggests that after sweeping liquidity above the previous highs, we could witness a deep weekly retracement. This move wouldn't necessarily signal a trend reversal, but rather a necessary return to these high-volume negotiation zones to trigger institutional orders and rebalance the price before a genuine continuation. We turn our attention to the NASDAQ 100 futures. In an environment where the dollar is being sold at price levels that are highly attractive to major market participants, the NASDAQ continues its upward trajectory, validating an Elliott Wave structure very similar to what we've seen in the S&P 500. It is fundamental to understand that market reading becomes deeper at this stage. Technically, the NASDAQ should exhibit an opposing behavior to euro to US dollar regarding relative strength. While the euro capitalizes on greenback weakness, the NASDAQ reacts with euphoria to the risk-on appetite for tech. Currently, we are in the development of the fifth wave, pushing toward record levels. However, this price overextension at all-time highs warns us that we are entering distribution territory. Just as with the previous assets, the key will be identifying momentum exhaustion to avoid being caught in the weekly correction that the market is beginning to set up. Analyzing the current context, the technical narrative suggests we should prioritize buying opportunities, which is a sound conclusion given the immediate trend. However, when we cross-reference the euro to US dollar data with the NASDAQ 100's behavior, we must proceed with extreme caution. We can observe that in the upper zones, just above the current price, there is a high probability of significant sell order blocks waiting to be triggered. These equal highs and all-time high, ADH, levels act as liquidity magnets. While the overall sentiment is bullish, we cannot ignore that institutional players often use these moments of euphoria to fill their sell positions. Therefore, even as we look for buying opportunities in the short term, we must remain vigilant for a potential liquidity sweep at the highs. Such a move could precede a corrective shift toward the sell-side liquidity, SSL, levels or the lower fair value gaps that remain unfilled on the chart. To wrap up today's analysis, we are looking at the Bitcoin weekly chart. The structure presents a fascinating narrative of manipulation and technical targets. After reaching new highs, price has left equal highs and bearish order blocks at the top, near the $122,000 mark. However, current price action forces us to look at the downside. We have a massive fair value gap, FVG, stretching from $88,000 down to $73,000. Efficient markets tend to rebalance these gaps. Furthermore, in the lower region, we see historical equal lows near $60,000 and $50,000, representing highly attractive sell-side liquidity for institutional players before any long-term bullish continuation. Tomorrow, we will continue breaking down the correlation between more assets, as high-probability opportunities are approaching, and we don't want to miss them. If you want to keep learning how to read the market professionally, subscribe to the channel and hit the like button to support this content. Leave a comment with your questions. I read every single one and reply personally. Share this tutorial if you enjoyed it and found it valuable. Thank you so much for being here, get some rest, and I'll see you tomorrow.